everyone, please note that we are recording. So I wanted to ask if there's any questions about anything in the class before we kick this off and we kind of start talking about some of the stuff that we were doing yesterday, Tuesday. If you want to, you can ask by chat, or if you want to, you can just wait till later. But yeah. First of all, is everyone hearing me? Okay, good. I just want to make sure that I wasn't at least being. All right, sounds good. So here's what I'm gonna do. Let's see here. Settings. I'm trying to think. Okay, so. So I'm going to go ahead. This is the screen that we've got. Of course, this is my computer screen. What I really want to start off with today is I kind of want to start talking a little bit about some of the things that we had kind of started on. As we had talked about earlier, and you know, this is sort of the corporate and individual income tax formula. We talked about this last week. I'm sorry, not last week, last class. Where essentially what we were doing is that we're saying that, you know, for the most part, the corporate tax formula and the individual tax formula is pretty much the same, with the mild difference that, you know, in the individuals we have the adjusted gross income, and then we have, you know, what we would call the above the line deductions, the below the line deductions, and those were two sorts of things that we had to grapple with in individuals that we don't have to deal with in tax. Something else that I mentioned is that, and we'll see this when we get to the next slide. And I guess if you want to think about it from a logical standpoint, there is a book to tax difference that happens on individuals, obviously, because if I go out and I buy a car, you know, and I pay, you know, interest payments on my car, I can't deduct that from my tax return anymore. Used to be able to, actually, up until I believe it was 1982, 83. You used to be able to deduct all sorts of interest, including car interest and credit card interest. Can't do that anymore. So what ended up happening is that you know, obviously, as from a financial perspective, as a human being, I lose that money because it's a cost that I have in order to have that loan, but I don't get a tax difference on it. Now, the thing is, when you build a tax return for an individual, you're not going to take every single little expense that they do and then try to figure out what they can do for tax and all that stuff. First of all, that's really not our job. That's something, you know, you give a list of stuff that the client can send to you, and then you'll go ahead and you'll accept it. But you know, for the most part, they're not going to hand you their entire bank accounts and say, okay, here, figure out everything that I've got that's tax deductible. You're going to talk to them about various things, and it's sort of going to be kind of more of I would say probably a little bit more indirect method as opposed to a direct method of just taking the stuff. But the way that we do the book to tax differences, and I kind of showed you something, and I finished this up yesterday, and I went ahead and I kind of threw together a trial balance, and what I did is, and the way I actually did this is I actually took one of my clients and I made sure that we had all the accounts that I thought were kind of interesting. There were, and actually I need to fix this because that's the only thing that we got that's going to be fine with it. And the big thing that I wanted to add is sort of this loan payments, and I'll explain why later on. But what I did is I sort of said, okay, I'm just going to create this trial balance, and then, you know, as we get done with it, you know, the first thing that you'll notice is that my trial balance zeros at the bottom, which basically means this trial balance balances. And here's the thing. I'm using Excel to kind of show you how to do this. Some of the firms that you're going to work at, they're going to have different types of software that actually do this for you. Pro Systems or CCH actually has an engagement software that does this. Another very common one that you'll see is Caseware. Auditors tend to like Caseware a lot because there's a lot of things they can do in Caseware. most tax people, we don't like it. And part of the reason why tax people don't like caseware oftentimes as much, it doesn't have an import function that that other software does. Here at our firm at Beta Solutions, we use a product called well, we use Thomson Reuters products. They have a product called Workpaper CS. And in Workpaper CS, I can build the entire trial balance just as we're doing now. I can do adjusting journal entries, I can do tax journal entries and all that stuff. The one thing that I've kind of noticed about it, though, is that because it's put into various aspects of the program, it's very hard to kind of see the big picture as you're kind of doing these things. So oftentimes, even if you do have a system that actually does a lot of this stuff for you, they may ask you to go ahead and build one of these kind of Excel work papers anyways, because the big thing that they're trying to do, and I'm going to tell you this as a reviewer, the biggest problem that I have is time. Okay, so what happens is as a reviewer is I go in and I take a look at it and I said, okay, this is a tax return that should take 10 hours to do. And I go in there and I notice that the staff has spent 15 hours doing it. Now, that may not necessarily be a bad thing. The reason why maybe they're spending extra time on it because there's something that the client gave to us that we weren't aware of. But that helps me to kind of budget my time, and also it allows me to go back to the client and say, hey, look, we thought it was going to take this much time in order to do your tax return. It's actually taking this much time, and here's the reasons why. This is why we're going to have to increase your fee. And oftentimes, most corporate clients understand that. They get that if it takes more time, they're willing to do it. You go to an individual, it doesn't happen. It's actually a much harder fight, I think. But corporate individuals, as long as you have an engagement letter that says, hey, if you do this, we're going to have standard hourly rates with this, and most of them are pretty understanding with that. They'll ask you for a ballpark figure, and then you kind of go from there. So this is the journal entry that I've gone ahead and built. As you can see, we've got it's typical things: $15,000 in cash. Now you'll notice that accumulated depreciation is a negative number, and the reason why we use that is because credits are described as negatives, and debits are described as positives. And so when we kind of look at this, everything that you see here looks kind of normal, so to speak, right? And the first thing that we talk about when we get an adjusting journal entry is that if I have a 1,000 account, which is typically an asset account, I expect to see them to be all in debits. Now, obviously, accumulated depreciation will be a credit, and that's because that's a normal balance for that. If I have a liability, I expect it to be a credit. Here, I don't have any problems with that. If I have stock accounts or equity accounts in the 3,000s, I expect them to be credits. Now, obviously, if your company has been losing money, they'll have a situation where their retained earnings is probably going to be the retained earnings is actually going to be a positive number or a debit number. That's very common, especially in small businesses when they're first starting out. So that's sort of some of the stuff that you have to kind of take into consideration. Income, we have our income is shown as a credit, which is a typical balance for that. We have this miscellaneous income, which is also shown as a credit. Everything's fine. And then all of our expenses are shown as debits. Now, you might say, Kevin, why are you going over this with us? I'm going to tell you something. I mean, just this year alone, I've had at least 4 clients who have sent me stuff that had trial balances with unusual balances. And I'm not even just talking about my tax clients. I'm talking about my audit clients. I have 2 audits that we're in the middle of doing right now, and I have a lot of expense accounts that are negatives, or written as negative numbers, and I had one who had a cash account that was negative, $200,000. And I don't know of a bank that's going to let you overdraw to the tune of $200,000, which usually when you're doing an audit and you see a negative $200,000, you're figuring one of 2 things happening. Either they're not reconciling things correctly, or there's some other issues that are kind of going on. And so oftentimes what will happen is that you'll see these show up as normal, but periodically you won't. So, like I said, for our tax clients, this is the work paper that we tend to use. We have the unadjusted trial balance, AJEs. AJE standing for adjusting journal entries. We have tax journal entries. There's also another type of journal entry that we didn't talk about yet, and that's called an RJE, and that's a reconciliation trial journal entry. We're not going to talk about those here, and part of the reason why we're not going to talk about them is usually you're dealing with a lot of reconciliation journal entries when you're doing consolidations. Obviously, well beyond this class, we're not going to talk about consolidated tax returns in this class. That would just be a little bit too powerful. So here's what we've got. Like I said, we've got all these sorts of things, and you take a look, and there's certain things that after you've been doing this for a while, you're just going to kind of gravitate towards certain things that you're going to have to figure out. So number one, you're going to see here, you see the retained earnings. And what I would end up doing, the first thing I would do on any tax return or any audit, the first thing that you always want to do, does retained earnings tie to your last year's balance? That's the most important question that you have to ask yourself. And here's why. So maybe I take last year's journal entries, and the way I do it, pretend that I open up, sheet 4. Obviously, sheet 4 doesn't exist. But if I open up sheet 4 and what I will do is I'll take everything from retained earnings down, I add it up, and I see this number, 85,978. So when I open this for the following year, that's what I should see as my total for my retained earnings. Now, some of you might say, why is this important? And part of the reason why it's important is if this number doesn't tie, somebody did a change in their bookkeeping system and hasn't informed you. Okay, so one of the things that we'll always ask our clients, in addition to getting an adjusted journal, in addition to asking for an unadjusted trial balance, we'll also ask them for the general ledger, and oftentimes we'll ask them for the general ledger for the previous year. And but now here's the thing: if I go and I say this and it says 85,978, and I go to my next trial balance and I notice that it says 84,600, I'm probably not going to care. I'm not going to contact the client and be like, whoa, what the hell's going on here? Usually, what will end up happening is, in order to get that beginning retained earnings to tie, I'll just make a journal entry into, the way I would do it is, in that case, I said it was 84,600, means my retained earnings is overstated. And so in order to get it down to 84,600, I would have to basically do a journal entry of, I'd have to do a journal entry of about 13,078. And that would be a miscellaneous expense, because what would happen is I'm lowering, it would be miscellaneous income. I apologize. It would be lowering retained earnings. And so the only way that you can lower retained earnings is that you have to recognize income. We would probably do that with some of our smaller clients, especially the people that, we don't really want to bug them too much. Maybe they made a small change after they gave it to us. We don't want to give them the impression that we're being nitpicky. And especially there's always kind of a cost value analysis we always do when we're going to go back to clients. If I notice that this is off and say it's off by $20, obviously I'm never going to go to the client and ask them about that. But if I go back and I notice it's off by $40,000, yeah, I'm gonna go back to the client. I'm gonna say, hey, look, I need you to run a trial balance for last year, and then I need you to run a couple other things. And more often than not, if retained earnings doesn't tie, the biggest reason why retained earnings won't tie, when we get done with this whole process, we're going to hand them all of these adjusting journal entries. And we're going to tell them, please make this in your accounting system. Chances are they won't, especially some smaller people. First of all, they may not know how to, and they're just afraid to tell you that. They may have another situation where they say, yeah, we'll do it. And then they set it down and they set it and forget it. They just don't do it. So sometimes you can go back and sometimes you have to remake that journal entry if that happens. But we're not going to worry about that. We're going to pretend that everything is fine. We've looked at the client, retained earnings ties. We thought it was going to be $40,000. It is $40,000. Everything's good to go. Okay, but we notice a couple other things, and I compare last year's to this year's, and I noticed that the fixed assets and the accumulated depreciations are the exact same numbers. Okay, so I go through this and I'm looking at this and I say, okay, I noticed that you haven't recorded depreciation. So what I'm going to do is I go and I look at my depreciation. We talked about this last year, last class. I'm going to change the number that we actually would have used last time. We'll say it was supposed to be a $20,000 book depreciation that they did not record, and then we're going to go ahead and we're going to record hit against the accumulated depreciation. I've made the journal entry. My journal entry is at 0. That's exactly where it's supposed to be. And so we'll go ahead and get that done. Now, what I also do here is I say, okay, AJE, why am I doing this? And the reason why I'm doing this is I go AJE1 to record current year's, whoops, depreciation. I think I spelled that right. Anyways, so then I go down here and I put a note here. Why do I do this? Obviously, it's what I'm doing. Why would I need to record that? Here's the problem. You're going to open this work paper in 6 months and you're going to be like, why the hell did I make this journal entry? May not happen with the first journal entry with depreciation. It'll be pretty easy to figure out. But you may be making some other journal entries that are kind of non-standard, and you're just like, I don't remember why I did that. So if you don't keep good notes as to why you did what you did, you're going to forget. Okay, so we want to make sure that we're doing that. Now, second thing that we noticed last year, I take a look at this. There's another thing that's wrong. We have the loan payments. I'm sorry, not loan payments. Let's forget loan payments for a second. It is wrong, but I'll talk to you about it. Cost of goods sold. Cost of goods sold is 0. Why is cost of goods sold set at 0? Well, they recorded their purchases of $100,000. We talked about this. We said that the inventory last year was at $50,000. I'm going to show you a different example where we talk about where you actually do the inventory and you find out that it's at $25,000. Okay, so if it's going to be at $25,000, in order for me to get this to record at $25,000, I'm going to just do this formula using a formula. Let's see, minus, yeah, $25,000. Oops. Sorry, no, I'm sorry, I'm screwing that up. Equals $25,000 minus $40,000. Okay, and did that work? So I have my $40,000. It's supposed to be $25,000. $25,000, which is right here. It ties. Everything's good. We're happy, and then I can get that done. But wait, there's more to this because obviously I'm not balancing. So we have to write off purchases. So I'm going to take purchases to negative, and now I've got $115,000. I'm sorry, $15,000 reduced. I've got $100,000 reduced. My balances are off by $115,000. So obviously my cost of goods sold is $115,000 because remember, cost of goods sold is beginning inventory plus purchases minus ending inventory equals cost of goods sold. And so we figure that out. We go ahead and we make that journal entry for them, and life is good. Okay. Now, the next thing I noticed, and I already alluded to this, I kind of gave this away. I'm noticing that they've made loan payments, and what they did is they just recorded it as an expense. Now, can I deduct loan payments from my tax return? And the answer is not really. There's a portion of the loan payments that you can, and that's called the interest. You can deduct interest, but you can't deduct loan payments. The reason is that when you borrow money, you don't pay taxes on money that you borrow. That would be ridiculous. Nobody would ever borrow money if they had to pay taxes on the receipt of it. So what happens is you have your, you borrow money, you receive the money, but as you pay the money back, you don't get a tax deduction for that. So what happens is I'm looking at this and I'm like, well, okay, so I know part of this is principal and I know part of it is interest. How do I know what the difference is? And there's two ways you're going to figure that out. Number one, you're going to go back to the client and you're going to say, hey, can you tell me how much of this was interest and how much was payments? If you got an accountant if you got a client who's maybe has an accounting department or maybe has a little bit of accounting knowledge, maybe they can figure that out for you. They can go back to the company that's got the loan and they can say, okay, well, according to my loan statement, this is how much money I paid in interest every year. I don't tend to do that with my clients. I tend to do this. I build what I would call an amortization table, and I'm already violating my first rule. I forgot to do this. So we have the we'll just say this is for what do we have for his name here? I'm trying to remember. Oh, my company. Okay, we'll just call it my company. FYE. All right. So let me insert this. Decrease this. I'm going to go ahead. I'm going to blow this up for you guys. All right. So what I do is I create an amortization table. I create these things all the time. Learning how to do one of these is very, very valuable. I would, in fact, sometimes I play around with this even when I don't have to, just to keep my skills sharp. So what I do is, you know, those of you who have ever taken a finance class, this should be a pretty easy endeavor. You have, so what we're going to do is, you know, you're going to have your N, which is your number of periods. You've got your interest rate, which is 5%. You've got your present value, which is the amount of the loan. And then you have your payment. And the way that we do this is, you know, these are all going to be given to you by your client. They're going to tell you it's a 5-year loan. They borrow $300,000. They paid at 5% interest. Now, here's the thing. If they tell you it's a 5-year loan, you've got to convert this into months. Okay. Now, there's 2 ways that you can do this. And I set this loan up this way in order to kind of to show this. And there's actually 2 different ways you can do this. You can just go ahead and just enter this stuff in, which is obviously the least preferred method. The other option that you could have is you could say a monthly rate, and then you have an annual. And instead of calling it rate, I'm just going to say monthly annual. So periods, I have, you know, I have a 5-year loan. I have it 5%. Oops. And then, you know, and then if I'm going to do that, what I'm going to do is I'm going to say, okay, equals this times 12 equals this divided by 12. Okay, and I think that should make some sense. Is there anybody who doesn't understand why I've done what I've done here? Okay, it tells me somebody's trying to talk, but I don't know who it is. Nope, I get okay. So everyone's actually silent. Okay, fine. So what we did is, you know, so this is your, you have 60 months, you have your annual interest, and then and then all that stuff. So when you have your annual interest, what you're going to do is you're going to figure out your payment. Now, payment is actually a formula that you would do in the within Excel, and this is basically what it is. It's I have it as positive, but it's actually not supposed to be positive. But anyways, that's not going to change anything. So payment, you know, which is going to give you your rate, which is this 5%. But this is the annual rate, so I got to convert it into a monthly rate because we're going to do everything on months. And then I have number of periods, which is 60. That's a monthly rate, so I mean monthly amount. So I'm going to leave it as is. And then I have this B9, which is the present value. Now you might ask, why are you using negatives? And the reason why is because this is going to try to calculate, when it calculates a payment, it's going to calculate in the opposite direction of whatever your present value is. Just for, you know, something that I've done, because I've done a lot of these amortization tables, I usually just go ahead and just make it a negative number so everything's positive and it looks clean. Because if I don't do that, here's exactly what happens. It does all of this, and then it's just a big mess. For me, you know, with one small negative number, one minus sign here, everything gets nice. Okay. Now I have various periods of the loan. This is how much their payment is. Interest is equal to, well, in the first line, it's going to be equal to the present value times the interest rate divided by 12. Principal is going to be payment minus interest. And then the balance of the loan is going to be whatever the last period's balance was minus the principal. Okay. So once you get to line 2, this is where you get to kind of have your fun with this. You're going to take 5% that you're going to hard code to, well, not hard code, but you're going to lock using these dollar signs to 5% to this cell B8. divided by 12 because like I said, it's an annual rate. Then you have and then you're going to take that as of your last balance that you had. And if you did everything correctly, you should notice over time your interest rates are your interest amount is decreasing over time, which makes sense. As you pay off the loan, you're paying less in interest. You should also notice that as you're doing this, your principal is going to be increasing, which makes sense because even though because your payment remains constant, your interest goes down, your principal has to be going up, which is one reason why if you borrow money for 60 months and you get to the halfway point, you're not going to be halfway paid off on your loan. You're only going to be probably at around probably a third to maybe a little bit more than that. So, well, here it's actually it's a little bit it's actually close to that. We have a pretty low interest rate here, but that's kind of what ends up happening with this. So, anyways, so that's how I get this done. I set this up for my clients because most of my clients don't follow this very well. I built this yesterday. Took me a huge 3 minutes. I mean, once you get good enough at these things, they're actually not difficult to do. And so I'm just going to label this as so this is the amortization table, and this is basically what you're going to be looking at. So I looked at this and I said, okay, I've got loan payments of $64,000. That's all they've done. So I go down and I've gone ahead of time, and then we're going to say this is their third year of their loan. And so, they started the loan in January 1st. We're just going to pretend that the first payment was due January 1st of, the first year of the loan. But this year, the current year, 2020, is their third year of the loan. So I've highlighted these things. So there's two numbers that we have to glean from this. Number one, of this payment, how much did I pay in interest? And if you take a look at this, I highlighted it. The total of this that's how much they've made in interest payments, is $8,085. And then how much do they make in principal payments? In principal payments, we do the exact same thing. Sorry, somebody with a motorcycle just drove by. I guess that was the most excitement we've got this morning. So we have the fact that they've made interest payments of $8,000. They've made principal payments of $59,000. And there's a couple ways we can take a look at this. This says 67,963 or 67,936 as their total. This says 64,936. Maybe did I make a mistake here? Oh boy, I must have. I guess I fat fingered something. Okay. Actually, I need to change this here real quick. We'll say 7. I'll bring rents down to $27,000 just to make sure that it'll type up. So this is how it should have gone. And that's how, and you notice it was a mistake. So I do this. Oh, sorry. So I've got the $67,000. That's kind of my check figure here. And so I'm taking a look at it and I say, well, $67,000, and I went to my balance sheet and it didn't tie out. So something would have gone wrong. Now in this case, because I was building this trial balance through kind of pulling numbers out of the air, that's what was a problem. But if I notice that I did this could also be indicative of maybe I'm adding up the wrong numbers. So the first thing I would do is check to make sure that I added up the correct numbers. I noticed that I did add up the correct numbers. Chances are what happened is I was attempting to enter in a 7 and I entered in a 4 and I didn't catch it. Okay. I try to label my my tabs here so it kind of keeps things a little easy. But basically, here's what's going on. So we did this. Now, in order for me to fix this, number one, the loan payments must be wrong. That's not what we're going to have here in order for this to happen. So I'm going to remove the loan payments. And then what I'm going to do is I'm going to record the interest. The way I'm going to do the interest is I'm going to use a formula. Now, some of you might say, why would you want to use a formula? And the reason is that as a reviewer, if I'm looking at this and I'm like, where did you get this number from? I don't have to write it in an email and say, explain to me how you got this number. All I have to do is go over here and say, I look at the formula. It says amortization table J38. I go to amortization table J38. Well, how do they get that number? And I calculate this. Okay, yeah. It allows me to do an audit, a self-audit, without me coming back to you and thinking you did something wrong. And if you do something wrong, sometimes I can just fix it and move on. It actually helps the reviewer significantly, and you might want to make sure that you're keeping up with that. So the notes payable at this point will equal. So you're going to want, what you're going to want to do is you're going to want to equal that. That gets me to where my balance lines up. We're all good there. My notes payable was at 184,021. It's now at 124,170. And then I can do is sort of a double check. And for some reason it's not. Oh, you know what I did? I bet I know exactly what I did. I see what I did. I see what I did. See, this is why I said I should have done the formulas to begin with. Oops. I should have done the formulas to begin with. Okay, well, format, we'll do that. Okay. And, let's see. We'll say 31,874,0. I should have built it that way. Anyways, so you take a look at that. This is what your balance was at the beginning. It's now 129,044. 129,044. This ties to your amortization balance as of here. Now, between you, me, and the fly on the wall and the NSA agent who's listening to this recording, I will tell you right now that this tying to the penny like that is almost impossibly rare. And part of the reason why is because the bank account, the bank statement that you end up getting with some of this stuff, they're going to be a few things. It'll be like $1 or $2 off. It's not a big deal. As long as you get it and you get it within a reasonable amount, that's going to be the most important part. If it's like a few dollars off, I wouldn't worry too much. But if you get to the end of it and you realize that you're actually off by, say $500 or $600, you might want to take a look at it and make sure that you've got the right numbers. All right, so I've taken a look at this and I've said, okay, fine. We've got all this stuff that we're going to do. And so that gets us to where we've kind of fixed this. Now, everything that we've talked about so far today is fixing their trial balance. Fixing their trial balance is the first step that you've got to do. It doesn't have a whole lot to do with book to tax differences, but if the trial balance isn't done right, you're gonna have an issue to deal with anyways, right? So you want to make sure that you get all this taken care of. And we go in, we take a look at it, we see if there's anything else. Everything else looks pretty good right about now. I'm kind of good for that. You'll take a look here and you'll notice that the accounts receivable, there's not an allowance for bad debts. If you're doing this as an audit, we probably would want to go ahead and add that. If this is purely a tax client, not going to care. It's not going to be that important to me. Okay. So any questions up until this point? None. Okay. So we've gone ahead and we've used these AJEs. I told you that we need to keep records. So I'm going to say for the records for number 2 is to remove businesses and record cost of goods sold, AJE 3, which is to correct loan payments for interest and loan balance. Okay. So here's what's going on here. So we have, for the most part, we've got the books done. It only took us a couple AJEs to do that. We're at 3. I'm not going to belittle this. There's usually about 4 or 5 more that we even would want to make, but I'm not going to make those because I think you guys get the point. All right, so I'm sitting here now and I'm going to start doing some tax journal entries. Now, the first biggest thing that's going to happen with tax journal entries, you have to ask yourself, number one, is my client a cash client or an accrual client? We're going to assume for the purposes of this lesson that they're an accrual client, and as a result of which, when they file their tax returns, they're going to pay taxes on an accrual basis. If they're cash basis, you're going to have to adjust this from cash to from accrual to cash. I don't know. Is there anybody who really wants to go through that? I'm willing to go through that if you guys want to see how it is. It's actually a very common journal entry you're going to make. And so if there's anybody who wants me to do it, please feel free to say yes. Now, I know these 3 yeses weren't with that. Okay. All right, so we'll go ahead. We'll just keep it as an accrual client. But there's a few things that we're noticing. Number one, the depreciation, we got it down to $20,000. We're going to say that we take a look at it. They didn't buy any new assets this year, and as a result of which, we're going to go ahead and we're going to say that the tax depreciation is actually less than it would be for book. And the reason why that would happen, maybe when we bought we bought some assets in 2018, you got to immediately expense them. And so as a result of which, you're going to have book depreciation on those, but you're not going to have tax depreciation. So we go ahead and we do an analysis on this. We realize that tax depreciation should be at $6,000. So I go ahead and I say equals $6,000 minus the L30, which is going to do an adjustment for $14,000. That brings my tax balance down to $6,000. What I'm going to do is I'm going to go ahead and I'm going to offset that with the accumulated depreciation. And then that's what we're going to end up doing for that. The second thing that I've noticed, I go ahead and I'm trying to figure this out. I noticed that my meals, I have meals. Well, what's the rules on meals? Meals are only allowed to be deducted at 50%. So half of this is not really an allowable deduction. So I'm going to take this, I'm going to say equals this divided by 2. So, and actually, I'm sorry, negative L32 divided by 2. So it's going to reduce my expenses by $500. To do the offset, I'm going to put it under non-deductibles. I'm going to take a look at it. Now, something else that we normally would take a look at here, and I've gone ahead and I've done this already. You have salaries and wages right now at $100,000, and you have officer compensation at $100,000. When we get to tax return reporting, it's important to have that broken out. More often than not, your clients are not going to have that done. What will end up happening is that you'll take a look at it, and they'll have $200,000 here, they'll have 0 here. And so what ends up happening is you may have to make a tax journal entry in order to break that out. So you say, well, there's $100,000 of officer compensation, but then I'm going to take, and I'm going to remove that out of there so we can kind of bifurcate that out. From a financial perspective, maybe we don't have to have the officer's salary and wages and compensation broken out, but from a tax perspective, we have to. So this is one way that we can do that. Okay, so I'm taking a look at this. Everything else looks pretty good. You guys don't want to do accrual to cash entries, so I'm going to go ahead and I'm going to record all this. TJE1 to correct depreciation to tax. TJE2 to let me see, to remove non-deductible meals expense, and TJE3, which is to now something else that you want to do as a reviewer or as a preparer of this. You also want to take a look at some of these expenses and find out if they have any fines and fees. So there's a lot of deductions that you're going to have in the corporation that's not deductible. And so when I take a look at those other deductions, I say, hey, there's $15,000 of other deductions. I'm going to go back and I'm going to ask the client, hey, can you provide me with your with your general ledger so that I can go through this? And say I go through this, and I have one client. I don't know what happens, but he works. He does a lot of travel, and he works at a lot of conventions. And for some reason, every single year he seems to rack up probably around $500 in parking fees, parking fines, because he's parked in an area where he doesn't have a choice. He has to park there, and maybe he doesn't get out to the meter fast enough, and as a result of which he picks up a ticket. So we go ahead and we figure out that the client here has $500 of traffic tickets. We're going to go ahead and we're going to put we're going to go ahead and we're going to remove that, and that'll end up taking care of that. Now, so I have PJE4 to remove DED-CTA. All right, so I make that note because here's what's going to happen. If 6 months later you open this stuff up and you're like, why did I remove $500 from this? I don't remember. You're going to have to do some investigating. If you just put a small little note here, you know exactly what you've done. Life is grand. Okay, so we've taken a look at this, and we've come to the conclusion that there's net income of $65,000 for book. There's $80,900 for tax. The client is going to end up paying a lot more in taxes as a result of this. There's not much you can do about that, but that's kind of the way it is. All right, so we've gone through all of this. I think when we go through the slides here real fast, you're going to notice that by doing this exercise, I've shown you a lot of things that would end up happening as a result here. But you're going to ask yourself, okay, Kevin, it's nice that you built this work paper. How does this help us in building the tax return? And this is exactly what I'm going to show you. So I go ahead and I bring up your corporate tax return. And I'm going to do this just so that we can scroll down. The two main things that you're going to be focusing on right now is going to be your balance sheet, which is your Schedule L, and then also your front page of your return. Now, obviously, you've got gross receipts, you've got cost of goods sold, blah, 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 so on and so forth. So now I've gone ahead and I said, okay, fine. I have my trial balance here. What's going to happen here is when I build my tax return, all of my balance sheet accounts, which is basically going to be all of these accounts right here, and you can tell that's the balance sheet accounts because it goes from 1,000 to 3,300. These ones here are going to be put into the balance sheet. And so if I were to build this, and I was going to build this as part of the balance sheet, what I would do is I would say, okay, and we'll say this is the first year that the client's done this. I'll have $15,000 here. Accounts receivable is going to be $20,000. They say allowance for bad debts. We don't have any, so we're not going to worry about it. All that sort of stuff. And then other current assets. Buildings and everything, $450,000. Accumulated depreciation, $200,000. Let's see. We don't have any depletable assets or any of that other stuff. So the total for my assets will be $315,000. Accounts payable is $20,000. Let's see. Oh, so other current liabilities is going to be $10,000. Let's see. Then you've got the notes payable. Now here's the thing. with notes payable for most of our clients, we don't normally do an analysis between what's due now, what's due within 1 year and what's not. A lot of your clients you're not going to do that with, but some of your clients you're going to. And so what ends up happening is, and I'm going to show you this here real quick, and we'll get back to it. But you'll notice that you have your notes payable, but the portion that's going to be due within the first year is that you're going to take this entire portion here, and you're going to say this is going to be your total that's actually due. And normally what we would do is we would do a journal entry to kind of break that out as a current portion of the notes payable. For most of our tax clients, we just don't do that. It's not practical. Most of them won't do it. Now, if you have an audit client, you will need to do that, because the audit, part of the audit is you need to figure out how much of that is currently due and how much of it is more long term. And so we just won't necessarily figure that out for most of it. All right. So then the next thing that we have is common stock. We have here $10,000. Our client doesn't have any preferred stock. You have APIC, which is $40,000. Then you also have your retained earnings, which, here's the thing. Now you might say, okay, Kevin, so I've got retained earnings. My retained earnings is $40,000, so I should probably just put $40,000. And the answer is no. You're not going to put $40,000. What you're going to put is you're going to put the sum of your retained earnings and all of your net income and everything to figure that out. So you're going to have 105,995.31, which is the amount that's here. And the reason is that this balance sheet is as of the end of the year. And of course, the first thing we're going to do when we do a lot of this stuff is we're going to close out the books. And part of closing out the books is that we're going to close out retained earnings to the we're going to close out net income and to the retained earnings. So we do all of this. My total balance that I have here that I need to put on the bottom, and this is sort of a check figure. It is, whoops, sorry, that's not correct. I have $315,000. That ties to my assets. Everything balances perfectly. Now, you won't have to physically enter into the actual schedule itself in order to figure this out. So what will end up happening is that you'll put this stuff into various areas of the tax return, and it will calculate for you. The retained earnings will actually calculate for you with the tax program, so you won't have to calculate the retained earnings on your own. But you want to make sure that it ties to what your expectation is, because if it doesn't tie, something's wrong, and you got to fix it. Okay, so that's what I put down for my book on my trial balance, and then we have here where we're going to build the tax return, where we're going to have this. Now, just for yucks and giggles' sake, I'm going to go ahead and I'm going to just say that our total net income per tax. And here's the thing, actually, and I forgot a very important thing. So I told you that when you build the balance sheet, you're going to use the book numbers. Okay, when you build the income statement portion of it, you're going to use the tax numbers. And so there's going to be a difference, right? There has to be a difference. There's a difference of whatever the difference is between these two items. Now that we'll take care of that here in a little bit. But say, for example, you're going to do that. We'll say that, instead of, just to save time, hold on, why is this not tying up the way that it's supposed to? Oh, that's right. This non-deductible will not be put into the tax return. That's why. Okay, so my net income is $80,955, and that's exactly what I'm going to put down here. We'll say net operating. Yeah, so we'll just say here it's $80,955 and change. Okay. Okay, so that's going to be my total. Obviously, I would have other numbers up here. I'm going to save you guys the pain of me just entering numbers in. And then you're going to say, okay, so what will happen is that I put that in. Income per line 28 is going to be $80,955.31. But here's the thing: book income is supposed to be at $65,955.31. Okay, there's a difference. What are my differences? And the big differences that you're going to have here are going to be all the differences that you've done in your income statement here. Now, when you're now, it's important to understand what really changes net income, book versus tax. Did this $100,000 of me reclassifying owner salary really change the net income? And the answer is no. It really didn't. What ends up happening is that what you've done is just really simply a reclassification. So this right here, I don't have to really worry about when I'm trying to figure it out. And what ends up happening is the two biggest things that are going to go on your schedule M1, anything that that basically isn't a reclassification entry. In other words, I have an income account hit, but then I have a balance sheet account hit. And you'll see that with the depreciation. Obviously, I decreased the accumulated depreciation, but it's a balance sheet account hit versus an actual expense hit. So there's a difference. You see what I'm saying? There's an incongruency that happens there because you're hit one hits to the balance sheet, one hits to the income statement. You don't have both of them hitting to the income statement or both of them hitting to the balance sheet, in which cases you're not going to care about it. But this $14,000 is definitely going to be a part of that. And I'm going to say, okay, this is going to be, because it's a reduction, what's going to happen is that it's an expense that's recorded on books but not deducted for the tax return. Here's the $14,000 that we put for that, and that's where that ends up going. We also have here the $500 for the meals and entertainment. Okay, so you're going to have $500 for meals and entertainment, and then you also have fines and fees. Okay, and so they had some fines. That's going to be, whoops, and actually, normally this built it for me, so I don't even have to think about it. Yeah, so we're going to say fines, $500. So the total of this is going to be $15,000. Okay, so when we have, so if I take all of this and I add everything up, so $65,955.31 plus $15,000 equals my $80,955.31. Now, I didn't have anything that was going in the opposite direction. So everything that I had increased taxable income, but there's nothing that really decreased taxable income. And so there's nothing for me to take over here. A very good example that would cause us to decrease taxable income. Maybe there's charitable contributions that I wasn't allowed to take in the previous year that I'm allowed to take this year, because something you're going to learn about corporation taxes. We only allow you to deduct up to the first 10,000 or 10% of your net income. So if I had made charitable contributions and say, and actually I think I did put, so I put charitable contributions in here, but it's only at $5,000. But if I had made charitable contributions more than $8,995, then I would have to suspend those charitable contributions above that amount. So that would end up being something I could deduct later on. It would be a temporary difference. So that's kind of sort of the difference. That's kind of how this ends up working. You get this done. You've got your balance sheet. It all ties up. Your M1 all balances. Life is great. And I've done for you in probably about, an hour, a process that normally would take probably about 5 or 6 hours. So I know I went through that real fast. The good news is we're recording this. We should have that up on the YouTube channel. The other one is up on the YouTube channel. I think I sent the link out for it, but if I didn't, I'll go ahead and I'll send that link out. If someone will remind me that they didn't get the link on that. So we've done all of this. This is exactly how the thing works in the reality of the world. Let's talk about what the theories are on this. So you've got the financial income that is often the starting point for computing taxable income. That's what we talked about here. Okay, your financial income is going to be here. The problem is, and here's what we ended up running into. And actually, I didn't even do this part. I should have, and I apologize for not doing this earlier. This is what the client provided us. Their net income, according to their books, was 41,401. That obviously was not the case. It's actually $65,000. So we had to fix their stuff. But financial accounting income is the starting point for all of this. But sometimes it's not right when we receive it. So we have to work with that. Okay, book to tax adjustments for differences between financial rules. We've gone ahead and we've done all of that. Unfavorable difference. Okay, number one, don't use these terms, favorable or unfavorable. Nobody cares. Nobody cares in this world. We don't call them favorable or unfavorable. I mean, I know sometimes the book's going to use that. I've never used these in the industry. I don't say this is favorable or unfavorable. What we do is we say that it's a subtraction to net income or to taxable income or an addition to taxable income. That's how we do it. Okay. Now, the book says that they're going to do this. Maybe they do that on the CPA exam. I don't remember them doing that on the CPA exam, but in my opinion, I wouldn't worry about the terms favorable or unfavorable. Now, temporary and permanent differences is a major term that you do have to know because they'll use that on the CPA exam and then also in life. So you have permanent differences that never reverse, and then you have temporary differences that will reverse over time. Okay? Okay, so some common differences that they say, you have, interest income from municipal bonds. Obviously, they say favorable. I really wish they wouldn't do this, but it's basically you'll have it to where it's going to help your tax income. Death benefits from a life insurance policy on key employees. So if the company buys a life insurance policy for a key employee, like if Beta bought a life insurance policy on me, I die, Beta gets the money. Well, Beta doesn't get a tax deduction for buying that life insurance policy, so when it receives the income, it's tax-free. Life insurance premiums, it depends on if you're paying for it for clients or not, or for employees or not. There's 50% of business-related meals, 100% of entertainment expenses. This is a new tax law change. Entertainment expenses are no longer allowed, so I can't go buy tickets to the Washington Nationals and write it off anymore. I can write off the food portion of it, but I can't write off the tickets on that, which is kind of stinks. Fines, penalties, and political contributions. This is for the most part true. I've seen where political contributions are allowed for deductions in certain states, but it's going to be for a state difference, not for federal. But for federal, it's definitely not going to be allowed. Excess compensation to executives. You also have federal income taxes and then dividends received, so on all that sort of stuff. Common book to tax differences. We already talked about all this. Well, we haven't talked about equity income, but I didn't want to get into it. But equity income, if you're counting your company under the equity method, that has to be removed. Tax doesn't care about the equity method. They're not, unless you're filing a consolidated tax return, that other entity is going to record their tax otherwise. Depreciation we talked about. We didn't talk about gain and loss on sale of depreciable assets. I wanted to keep the trial balance kind of easy, but that is a very common one. Organizational startups and unearned revenue and deferred compensation are also some very common ones. Capital losses. So if, as a corporation, if I sold some stock and I have a capital loss, book's going to let me take a deduction against my net income for that, but I can't do that for under tax. So and remember, individuals get a $3,000 write-off every year. Corporations don't get that. Okay, so if you have capital losses, they're suspended until you have you can do the carry back, carry forward provisions that go on. All right, so then you have book to tax differences. So dividends. What's going to end up happening is that you'll have dividends that need to be broken out, and part of the reason why is for book income, all I care about is that I have dividends, and dividends income is just increased my taxable income. But for tax purposes, we have to break it out, and it's going to be like one of those things we're going to do a reclassifying like we did with the salaries of the officers, where we said, okay, there's this $100,000 we just have to reclassify. Maybe this miscellaneous income is actually, and we'll say for example, the miscellaneous income is interest and dividends. So we're going to go ahead and we're going to increase this 5001, 5002. We'll say interest income. Dividend income, I take it to 0. Okay. And then I say, okay, so one of my things that I'm going to do for tax, maybe I go ahead and I say I had $1,000 of this is interest income, and maybe $1,000 of it is is dividend income. I go ahead and I add these two up. It gets rid of it. Now I've reclassified it. Why is that important? Dividends are not taxed at ordinary rates. They're taxed at capital gains rates. And that's in corporations that goes the same too. Even though they will have the dividends received deduction, we're not going to cover that in this part here because it would be adding a lot of stuff to it that I just don't want to get into. But it is definitely something that is entirely possible that we would have to deal with. You have 100% dividends received deduction from a 10% or owned foreign corporation and not previously immediately subject to immediate taxation under subpart F. This is a very complicated area. We actually do this at Beta a lot, but I won't talk about it because subpart F income, even when I took international accounting at the master's program, international tax, this was a hard conversation to have. So. Also, income included if it depends on ownership. Again, under book, if it's 20% or less, there's not going to be any income included. If it's 20 to 50%, you're going to have the equity method, and then if it's over 50%, you're going to have the consolidated method for book. For tax, it's a little different. The tax, they're basically the equity method doesn't exist, and consolidation occurs at 80% or more. So that's basically what ends up happening. So there's a few differences that end up happening there. You'll need to understand a little bit of this for the CPA exam, but I wouldn't worry too much about it until you start working at the corporate world before you're going to have a little bit of that. So we have a few examples. Starting in 2017, there's a limitation on net interest expense. So corporate net interest deductions are limited to 30% of taxable income before deductions. Okay, so what does that mean? Let's pull up our example here. I have their total interest expense at $8,085. Okay, so I will take the $65,009. I'm sorry. No, actually, back up. I'm going to take the $80,955 because that's their taxable income. I'm going to add the interest back in. And then the total for the net income here, and actually I'm going to do this down here so that you guys can actually see this. Equals. So total net income. So total net income for this is actually going to be $89,040. I take this times 30%. So I have $26,000 of up to $26,000 of interest income that I could deduct before I hit this 30% limit. Now, our interest is $8,000, so we're not going to worry about the limit. The limit's not applicable to us because we don't hit it. How does this? So what happens if you do? You're going to suspend some of that interest expense until you have sufficient income in order to be able to do it. Now, there is an exception for small businesses, and it says here the limitation does not apply to taxpayers with average annual gross receipts of less than $26 million. Obviously, our client, with a huge whopping, income of $500,000 is well under that $26 million. And so we don't have to worry too much about that in order to get that done. So that's not a big deal. Stock options, we didn't talk too much about stock options. I'm not going to worry about it. More likely than not, you're not going to have to deal with this if you get into the industry as a staff. And when you do have to get into it later on, they'll talk about it a little bit more. It depends on your organization and what you're going to go work with. So net capital losses, you have no concurrent deduction for net capital losses. I just said that. The $3,000 limit doesn't apply to them. It doesn't apply to corporations. It only applies to individuals. You have carryback of net operating loss for 3 years and carry forward for 5. That rule's been in place for years. Sometimes they modify it if they realize that there's a financial crisis. Like right now with this whole COVID thing, they could modify this where they say, look, we're going to let you take capital losses going forward that are incurred this year. We're going to let you take those going forward for 10 years or whatever. They've done that in the past. I expect they could do that again. Depends on what the mood of Congress is at the time. Net operating loss deduction, so there's no tax benefit from a current year loss. In other words, if your company loses money, you just go to zero taxable income, and then you just file your tax returns. Zero taxable income, nothing due. The net operating loss, however, carries forward so that next year, when you actually make money, you can actually take those NOLs and you can deduct it in the following year. NOLs from pre-tax years can be carried back to and forward 20. Obviously, this is going to fade out here very quickly. Basically, Congress doesn't like this whole carried back. I mean, it makes sense to do so from a theoretical standpoint, but it does create a paperwork nightmare. So they did allow for carry back 2 only because what if you had a situation where you had to recognize taxable income in the current year, but it was because you weren't able to write off the cost of goods sold until the following year. I actually have a client who's going through this year. Luckily, he's accrual, so we don't have to worry about it. But in a cash basis, he would have to record the income this year, and then next year he would have this huge loss because he doesn't have any carry back. He'd be out a lot of money owing taxes. So we decided to keep him as an accrual basis taxpayer for this reason. So this is kind of what's going on with that, what they've done with it. Congress, I think, that just decided, when they did this Tax Reform Act, one of the things they decided to do is help the paperwork at the IRS to make sure that some of that stuff gets done. All right, charitable contributions kind of works the same way that it does for an individual, except for you have this accrual method. It's deducted when the board of directors approves it before year end, and it's paid within 3.5 months. Why 3.5 months? When is the corporate tax return due? April 15th. So as long as it's paid before the corporate tax return is due to be filed, everything's good. Now, does that mean that you can't file the tax return until that charitable contribution is paid? That's not the case. Most times we'll tell our clients we won't do it until it's paid, only because if for some reason there's say for example, God forbid, and I'm definitely not wishing this on anyone, you say you're going to make a charitable contribution, you approve it by the board of directors, February 23rd, another 9/11 happens. All of a sudden, your industry goes down the drain. You need that money. We've gone ahead and we filed your tax return because we were fast and got your tax returns done. I now have to do an amended tax return in order to get you to remove that deduction. Maybe you have to pay more taxes. It's just not worth it. So oftentimes we wait until the client has actually made the payments before we actually do the filing. All right. They say deduction is limited to 10% of taxable income before deducting any charitable contributions and the DRD and capital loss carrybacks. Carry forward excess contribution for 5 years. So if you're a corporation that's extremely generous and wants to donate a whole bunch of money, but maybe you lost money because there's a paper loss that happens on your tax returns, this can actually discourage some of that stuff. But it's important that you work with your clients in order to make sure that they do their charitable contributions and manage it correctly. This is why a lot of corporations that do charitable contributions will set up charitable contribution committees to make sure that they don't bust this rule, but at the same time, they want to make sure that they're still being generous to the community around them. So the DRD, you have the deduction to mitigate more than 2 levels of tax. Okay, so here's the thing. I want to talk about this later on, but we're getting to 8:43. I want to make sure that we don't just skim over this and kind of blow through it. This will put us a little bit behind. I'm not worried about that because a lot of the stuff that we talked about today will also be applicable in future classes. So we're going to keep this Excel as an example that we're going to use throughout the year. I may modify it a little bit as we talk about partnerships, as we talk about distributions and things of that nature. So maybe I make some modifications to it. But this is going to be kind of our baseline stuff that we're going to follow as we build throughout this this semester. Is there any questions for me before we end class? Okay. Just as a short reminder, there is a 4 o'clock office hours session today if you want to talk to me about the midterm. I have that on my calendar. I am looking forward to it. Whoops, oh, I don't want to share that with you guys. So I have it on my calendar. That'll take place at 4 o'clock. I have a client meeting at 5 o'clock, so I'm not going to be able to be very verbose about this. Would it be helpful for me to just move the scheduling of it to 3:30 in case there's anybody who has additional questions? Would that be helpful for people, or is 4 o'clock just the best way to have it? $3:30 works. Okay, I'm going to go ahead and I'm going to move this up. I'm going to expand this to 3:30 for me. And then I'll put it out in an email that says, hey, look, just because of that, we'll get that done. Or I can just give it to you guys as a bonus because y'all showed up to class. The other guys didn't show up. So, maybe we just give that to you guys as a bonus. How does that sound? It's like, Professor's being vindictive. Professor's being vindictive. I'm not being vindictive. I mean, if you think about it, fairness should happen. I mean, I'm a fair guy. I believe in being fair. So anyways, as I've said that, so as Forrest Gump would say, that's all I got to say about that. So I'm going to go ahead and end recording right